Netflix and Tesla are two popular stocks making notable moves as of late. So let's analyze the stories behind the stock action with Netflix and Tesla earnings around the corner. Ross Gerber, CEO of Gerber Kawasaki Wealth and Investment Management, is here to weigh in on those two names as well as Disney. Hey, Ross, thanks for being here.
Thank you.
All right, well, let's start off with Netflix, which is a big beneficiary, of course, of the stay-at-home trend. It's known for its strong pipeline of original content. And it seems like they're still the clear leader here in the streaming space. So what do you think they need to do to maintain that leadership?
Yeah, it's funny because what I thought Netflix needed to do a few months ago now doesn't matter anymore because the theater business looks like it's going to be shut for some time. And even when it's open, it's probably not going to be that lucrative. So it turns out what I thought was originally Disney's strength in the business model, having the bricks and mortar diversification, is now Disney's weakness. But for Netflix, it actually works perfectly. So there's two things really working for Netflix right now. Number one, the fact that production in Hollywood is pretty much slowed down to a stop. Netflix had invested so much money on content for the future. And at the time, it just seemed like a lot of cash flow being spent. But now they have content for the next year or two that's already done. And it really puts them in the driver's seat, as many of their competitors just simply don't have new content like HBO Max. Disney's not in that situation, but I think because everybody has so much more time to watch things now, that both Disney Plus and Netflix are big winners right now, but especially Netflix because the content has been excellent. So that's number two. It doesn't matter if you're in the pole position if the content isn't good. The content's been excellent on Netflix for the last 3 to 6 months. So we're expecting just a really good year for them.
Does it concern you at all, though, that management said in the last quarter that it was a little bit cautious about subscriber growth in the back half of the year due to huge gains getting pulled forward earlier in the year?
I don't think any CEO knows what's going to happen. And I think that was under the assumption that things would, I think we had this assumption this would be a 3 or 4 month event, and by fall we'd be back to our normal lives. That is not going to be the case. And so I think any assumption that we're going to go back to, say going to theaters and bars and concerts where it would take our eyeballs away from Netflix is gone, I think, for the year. So I think that assumption is incorrect right now. I think we're all stuck watching Netflix for the rest of the year, and I see them adding more subs than they've ever added in history.
Yeah, well, only time will tell. We'll have to see with the next quarterly report. But elsewhere in the content space, let's talk a little bit more about Disney. Definitely another popular, widely held stock out there. But the stock has seen much better days. And it really was Disney Plus that was the driving force behind Disney's impressive stock gains in 2019. But it's Disney's parks business that's squarely in focus for investors because of the coronavirus pandemic. And it's not looking too great right now on that front for Disney.
No, and I'm a huge Disney bull, and I've been a shareholder my whole life. And I love not only the parks, but the content and just Disney. And that being said, they have half their businesses going great. Thank God they went direct to consumer with digital, and thank God they took over Hulu, or else they'd be in real trouble. But the sad fact is that they make a lot of money in parks, cruise, and resorts, and I just don't see that getting back to normal till next year. And I'm hoping by next summer, and that's a hope. And so, it saddens me to say that Disney's going to have to kind of struggle through the year and then hopefully get back on its feet as soon as possible. So we've moved from a buy to a hold on Disney. But I also think management's great, and they have the capital, and they've got this great business now that's growing way faster than what anybody thought. And Netflix is valued more than all of Disney. And so if you really look at Hulu and Disney Plus, and then all the other assets, Disney is a very cheap stock right now if you think out a couple years from now. And they're going to get a great head start in streaming now.
But the parks business, like you said, it's not very clear at this time when that's going to improve. So what signs do you think investors should be looking at? You're saying it may not be till next summer. So right. Is this a type of business that we could be waiting for a vaccine for things to meaningfully improve, even though parks are expected to reopen at least a little bit this summer?
Yeah, boy, this is so hard for me because I consider myself a fun person, and I love going out. I'm in the music business too, and seeing all my musician friends and myself idled for who knows how long. And these, even for small venues, are struggling with the idea of having 20 or 30 people. So imagine trying to run a venue with 20,000 people a day and 10,000 employees.
Yeah.
It's impossible for people not to get coronavirus in that environment. So I think that we're going to be dealing this for some time to come, and large gatherings and things like Disneyland are going to be real tough to have open and safe, despite, I think, the demand for it, when especially people have not been, covering, using masks and using common sense in their behavior. So we're going through a stage now in America that it's in entertainment, or whether it's shopping or anything else, is that we're all going to be using digital solutions from the workplace to everything else for the time being. And then when things get better, I think a lot of these things are going to continue.
Okay, well, now let's shift gears here a little bit. Tesla has seen big gains during the market rally, and it's been an incredibly strong stock. And it's also one of the most hotly debated companies out there. So what do you think Tesla is doing right at this time?
It's a real good feeling being me right now, because a year ago, the stock was, in the 200s, low 200s, and getting battered, and Elon was mired in issues, and the SEC and short sellers, and now he's getting 10-year anniversary articles. He was in the cover of Barron's CEO, top CEOs, and boy, it's amazing the difference a year makes. Tesla's done a lot of things right, but I think what's really working for Tesla are trends that are bigger than Tesla. Number one, it's climate change. People in the world want an alternative to gas-powered or ICE engines that are destroying the environment. And we all know that the solutions exist for climate change now. Right now, as of today, between solar, renewable energy, batteries, and EV technologies, there's no question we can reverse the effects of climate change in the next decade. But we have to implement things like electric vehicles and an infrastructure of batteries like what Tesla's doing to succeed at this. It turns out there's no competitors. So Tesla doesn't have a competitor, and they are the only company making EVs in mass and scale, batteries in mass and scale, and now soon to be solar in scale. And what a opportunity over the next decade. So Tesla's just getting started, and they're going to have a globally dominant company over the next decade. And I think investors would be making a big mistake to miss this one. The second thing is being a digital business. I just bought a new Model Y for my wife. The entire process can be done on your phone, from getting your insurance, getting your car loan, picking up your car. You just drive up to Tesla, you get in your car, you check in, you get in your car, and you leave. I've never experienced anything like this in buying a car. And in fact, most people would argue that buying a car is one of the worst experiences they can have as a consumer. So Tesla has this huge advantage that none of its competitors can sell a car over the internet or over the phone. So if you're worried about COVID and you don't want to go to test drive cars at a dealership, Tesla's your solution. And so I think a lot of people just really like the technology of being able to buy a car with your phone. And that's really helping Tesla. And not to mention, they're now delivering globally, and everybody in the world cares about climate change. And now Elon Musk, especially after launching humans into space for the first time from American soil in over a decade, has become an even bigger iconic folk hero for the Gen X generation. So, I'm buddies with it. I love Elon, and I'm super happy to see him doing so well and the company doing so well, and of course for our investors as well.
Now, you touched on deliveries. That's, of course, another key metric here for investors in addition to profitability. So taking a step back and looking at deliveries over the next couple of quarters, perhaps, or into the next year, what ideally would that look like for Tesla, and what should investors keep an eye out for on that front?
So, with Tesla, they're still going to have to deal with macroeconomic issues like everybody else with every business. And so we're just not sure what we're going to look at the economy in 6 months, and it'll affect Tesla as much as it'll affect Microsoft or anybody else. So the issue with Tesla, to their advantage, is people switching from ICE to EV in great numbers and not having other choices than Tesla. So that helps Tesla. Right now, Fremont's back up and running, and assuming that there isn't a disruption between Shanghai and Fremont, they can make well over 500,000 cars a year, and that's what they were planning on before the pandemic. So they're currently constructing the Gigafactory in Berlin, and they're looking for another site. They're expanding China, and they're looking for another site. It looks like Austin, Texas. So Berlin won't be up for another 2 years, but Shanghai is growing very rapidly right now in its production and size and scale. So I think for the quarter, it's going to be very interesting to see what Tesla's able to deliver, because the Chinese factory was able to get up and running a lot sooner than the US factory. And so for the first time, we can really see some China sales that maybe helped offset the loss of US sales for that month. But I think when you go out into Q2 and beyond, with both factories up and running, Tesla can get on track to delivering over 100,000 cars a quarter, and that's what they need to do to be profitable and to continue to grow the business. And so we expect that 100 to 125,000 cars a quarter in Q2 moving forward. But once again, it's so hard to see what economics are going to be in 6 months, for example.
All right. Well, to cap things off here, Ross, if you could give Elon Musk one piece of constructive criticism, what would it be?
Get a real name for your baby. It's unbelievable. No, it's unbelievable to call your kid X and AE72R. I get it. But this kid has to live with this name, you know? Pick a name, you know, Ben works or Steve, and you know, stick with it. So that would be my advice.
All right. We'll have to let him know. Or you'll have to tweet him.
He watches my interviews, I think, so he might see it.
Okay, well, good. All right.
Yeah.
Well, we've got to leave it there for now, but thanks so much for your insights today, Ross.
Thanks for having me. Appreciate it.
And thank you all for watching this episode of Investing Strategies. This is Alyssa Korn for Investors Business Daily, and we'll see you next time.